Valley Mole.
Hi, I'm David Smith and this is Valley Mole, the show that digs in and around Silicon Valley, searching for insights into technology news stories, the patent wars, and the business of startups. Dropbox has just announced that it has closed a financing raising $250 million from venture capital investors in the Series B round of financing. Now, $250 million is obviously great for financing growth of the company, great for acquiring servers, great for acquiring other companies, but is it great for the founders? Now, the reason why I'm bringing this up is because the founders have to stand in line behind the shareholders, the holders of preferred stock, when the company is sold. Typically, when the company is sold, the founders have to wait until the investors have taken out the money they invested, and then they share the proceeds of the profits with the founders. That's called a liquidation preference. Now, the liquidation preferences are often 1x, which means in this case, the shareholders will take out the $250 million they invested. Now, if the liquidation preference is 2x, then those investors take out twice the money they invested, so they'll take $500 million out of the proceeds of the sale before sharing the remainder, the profits, with the founders. And typically in Silicon Valley, the liquidation preferences, you'll see them in all venture capital investments, all preferred stock investments. Almost all of them have these liquidation preferences, and the average is between 1 and 2. There are websites and publications by lawyers that monitor what the averages are, and the average is typically about 1.5. So if the average was applied here, I don't know what the liquidation preference actually was on this $250 million, but if it was the average, typically it would mean that the founders of Dropbox are standing in line behind about $400 million of liquidation preference when Dropbox is acquired. All that first $400 million or so will go to the investors before the founders see a penny. Now, this all changes at IPO. At IPO, all the preferred stockholders, the investors in this case, the venture capital investors, have to they swap their preferred stock for common stock, and they lose those liquidation preferences. So liquidation preferences go away and the line basically disappears. The founders are equal in line to everyone else. But of course, at IPO, the founders are locked out from selling their shares for a period of time. It could be 6 months. I've seen cases where it's 2 or 3 years before the founders are allowed to sell any of their shares. And then, of course, when they do, they're subject to the insider trading regulations, and they can only sell certain amounts at certain times. So the line gets longer and more investors push in front of the founders the more money they raise. $250 million is a lot of money to raise, and there's a pretty long line between the founders and the cash when it comes to selling the company, in the case here of Dropbox. So when it comes to raising finance from the perspective of the founders, less is often more. We'd like to thank the sponsors of Valley Mole. Tynex, the full-service patent broker operating the world's largest patent and technology trading exchange. Silicon Valley Business School, offering unique educational programs and materials to students and teachers of entrepreneurship and technology commercialization. And ValueMyPatent.com, the only place to go for rapid, realistic patent appraisals.